Welcome back to the deep dive. So today we're going to dig into a headline that really sent some shivers down Wall Street's spine.
hmm
AbbVie's recent Q2 2025 earnings warning. We're talking an $823 million hit.
Yeah, that's a big number.
Translates to, what, $1.42 drag on earnings per share? I mean,
Yeah.
investors get antsy when they see that.
Oh, absolutely. A number like that, it screams danger on the surface. You see why the shares dipped?
Right. But is it really the catastrophe it looks like on paper? Or is there, something more strategic happening underneath?
That's exactly it. The numbers, well, sometimes they don't tell the full story, do they? This warning, yeah, it's painful short term.
Okay.
But it actually points to a pretty deliberate strategic play by AbbVie. They're not just reacting. They seem to be proactively building.
Building for the future, you mean?
Precisely. So our deep dive today is really about why this might not be a red flag, maybe more of a calculated yellow light.
Okay, I like that. The yellow light. So let's zoom in then. That $823 million charge in Q2. What exactly happened there? How did that work?
Right. So fundamentally, this was mostly a non-cash charge. It's tied to what's called acquired in-process research and development, IPR&D.
IPR&D.
And milestone expenses, too. It comes directly from their recent M&A, their acquisitions. The big one being Capstan Therapeutics.
Okay. But help me understand, why does buying R&D, even if it's promising, hit the earnings right now? Seems a bit strange.
Yeah, it can feel counterintuitive, but it's really just how the accounting rules work, GAAP accounting specifically.
Right.
When you buy R&D that's still being developed, stuff that isn't generating revenue yet, well, you generally have to expense it immediately.
You can't just put it on the balance sheet as an asset for later.
Not usually, no, because the future success of revenue, it's not guaranteed yet. So boom, it hits the income statement right away.
Got it. So it lowered their Q2 guidance, I saw, from over $3.25 down to, what, $2.84 to $2.88 a share.
Exactly. And trimmed the full year adjusted EPS guidance, too, down to the $11.67 to $11.87 range. But, and this is key, it doesn't mean their core business, their existing drug sales, suddenly fell off a cliff. It's an accounting reflection of investment.
An investment in potential future drugs.
Precisely. Potential future revenue streams.
Okay, that accounting piece makes sense. But still, $823 million right now. Shareholders feel that. Why make these huge investments like that $2.1 billion Capstan deal? Why right now?
They still have strong drugs, right?
They do, but this is where you have to look at the bigger picture, the long-term strategy.
Okay.
AbbVie's longtime cash cow, Humira, it's facing massive competition from biosimilars. That revenue stream is shrinking fast.
The patent cliff everyone talked about.
It's here. Now, their newer drugs, Skyrizi and Rinvoq, they are doing really well. Fantastic replacements, actually.
Yeah, I've seen the numbers on those. Impressive.
Absolutely. But management knows you can't just rely on 2 or 3 blockbusters forever. You need a deep, broad pipeline for sustainable growth.
And building that pipeline internally, that takes time. A lot of time. Years. Decades sometimes. And it's risky. Lots of failures along the way. So instead of just waiting and hoping their internal labs strike gold again and again,
They're buying it.
they're aggressively accelerating things through acquisitions. Deals like Capstan bring in those promising next-generation candidates.
Even though they cost a lot up front and cause these accounting hits.
Right. It's a proactive choice. They're sort of racing the clock to lock down future growth rather than just, sitting back.
That makes strategic sense, especially in pharma, where pipelines are everything. But does it raise concerns? Is AbbVie leaning too much on its wallet?
That's a really fair question. A valid critique, actually.
Like maybe their internal R&D isn't firing on all cylinders.
Some critics definitely argue that. While this charges for acquired R&D, the argument goes, maybe they have to acquire so much because their internal discovery engine hasn't been, let's say, a consistent home run factory. For every big internal success like Skyrizi, maybe there have been other projects that didn't pan out, forcing them to shop outside at, frankly, pretty high prices.
So it could signal a bit of weakness in their own innovation process?
It could, or you could also argue that R&D is just incredibly tough. Even the giants have dry spells. It's a high-risk game.
Right.
So the real test isn't just the price they paid today. It's whether they can take these expensive bets, these acquired molecules, and actually turn them into the blockbusters of tomorrow. That's the multi-billion-dollar question.
Okay, so we've got the charge explained, the strategy behind the spending, even the potential critique about internal R&D. But let's pivot to the positive. what are the bright spots that make this short-term pain potentially worthwhile for investors?
Well, there are definitely bright spots, big ones. Like we touched on, Skyrizi and Rinvoq are performing exceptionally well.
The Humira replacements.
Exactly. They're already pulling in billions. The projection is for them to exceed something like $20 billion in annual sales by 2027. That's huge.
Wow. Okay, so those aren't flukes.
Not at all. It shows AbbVie knows how to pick winners, or at least develop and market them effectively once they have them. And beyond immunology, they're making smart moves.
Diversifying.
Yeah, diversifying into areas like neuroscience and oncology. High-margin, high-need areas.
Like the Cerevel acquisition.
Right, that brought in assets. They've got Vraylar for depression doing well, Ubrelvy and Qulipta for migraine gaining traction. These are significant markets.
And oncology.
That's another key area. They've got Elahere for ovarian cancer, Epkinly for certain blood cancers. It points towards a more diversified revenue stream down the road, not just relying on immunology.
Okay, so the pipeline, while under construction, like you said, has real potential beyond just Skyrizi and Rinvoq. What about the dividend? That's crucial for a lot of AbbVie holders. Is all this spending putting that at risk?
That's a great point to bring up. And the answer, frankly, is no. The dividend looks very safe. It's actually kind of a hidden strength right now.
Really? Even with billions going into M&A?
Yeah. The yield's attractive, around 3.5%, and they have, a decade-long track record now of growing that dividend consistently.
Okay.
And it's well covered by their free cash flow. They generate a lot of cash. So despite the R&D splurge, that income stream for investors seems secure. That's a critical anchor.
That is critical. So let's tie this all together then. If the charge is accounting for strategic investment, if the pipeline has these strong points, and if the dividend is safe, why the market sell-off? What did investors miss or misunderstand?
Well, it's often about short-term versus long-term perspective, isn't it? The market reacts instantly to headline numbers, especially negative earnings revisions.
Right. The algorithm sees negative $1.42 EPS and sells.
Pretty much. It's a reflexive action. They see the immediate hit, the cost, without necessarily weighing the long-term strategic necessity of that investment.
It's like you said earlier, the yellow light versus the red flag.
Exactly. And think about the alternative. As the source material we looked at pointed out, if AbbVie hadn't made these aggressive moves, if they'd just let Humira fade away without significantly reinvesting,
then analysts would be screaming about a weak pipeline and no future growth prospects.
Precisely. It's a classic damned if you do, damned if you don't scenario in some ways. You invest heavily, you get hit on near-term earnings for IPR&D. You don't invest, you get hit for lacking a future pipeline.
So management has to choose the path for long-term survival.
Right. And good management builds for the future, even if it's expensive or causes some short-term pain on the income statement. That's why most analysts, despite the warning, still have buy or hold ratings.
With price targets still well above the current price,
right.
Like $210 to $240.
Yeah, suggesting they see the long-term value story remaining intact despite this quarterly adjustment.
So wrapping this up then, AbbVie's Q2 warning, definitely a wake-up call. Made headlines, but maybe not an obituary.
Far from it. I mean, it looks like a company making some bold, arguably necessary bets to secure its future in a really tough industry.
It might look messy now, might feel painful if you're watching the stock day to day.
Sure, but it seems like a strategic evolution, maybe an unavoidable one.
The pipeline isn't broken, it's just under heavy construction. And construction costs money up front.
Well put, yeah. It's not panic time. It's probably more like business as usual for big pharma. Innovate, acquire, diversify, protect that shareholder income stream. That's the cycle.
So as you, our listeners, think about this, maybe consider how often those big, scary headlines can sometimes mask what's really going on strategically inside a company. What other news stories, what other apparent red flags might actually be more like these yellow lights if you dig just a little deeper than the surface numbers?
Yeah, looking beyond the immediate reaction to understand the long-term game plan.
It's a good reminder that being truly informed often means asking those next-level questions and trying to see the bigger picture.